Some people make a lot of money somehow, but how? If the stock market confuses you, you're not alone.
Hello guys, welcome back to our channel. Today we will talk about how the stock exchange functions. So in this video we will talk about what stock exchanges are and how the stock exchanges work. So stock exchanges are places wherein the people working bring different corporations, either government funded or even private corporations, to buy and sell equities. More advanced stock exchanges even offer electronic stock exchanges that do not require physical locations and other places. Then there is a new concept that is currently surfacing, which is named as auction-based stock exchanges. Some stock exchanges have already implemented this, like the New York Stock Exchange. In this new concept, the company allows the buyers and the traders to verbally communicate and tell the orders as per the buyer's requirement. Now further, we will talk about how the stock exchanges work in full detail. A stock exchange is where different financial instruments are traded, including equities, commodities, and bonds. Discussions bring up corporations and governments together with investors. Conversations help provide liquidity in the market, meaning there are enough buyers and sellers so that the trade can be processed efficiently without delays. Businesses also ensure that trading occurs in an orderly and fair manner so crucial financial information can be transmitted to investors and financial professionals. Stocks first become available on an exchange after a company conducts its initial public offering. A company sells shares to an initial set of public shareholders in an IPO known as the primary market. After the IPO floats shares into the hands of public shareholders, these shares can be sold and purchased on an exchange or the secondary market. The exchange tracks the flow of orders for each stock, and it's the flow of supply and demand that establishes a stock's price, depending on the type of brokerage account. You may view this flow of price action. For example, if a stock's bid price is $40, this means an investor is telling the exchange that they are willing to buy the stock for $40. At the same time, you may see an asking price of $41, meaning someone else is willing to sell the stock for $41. The difference between these two is the bid-ask spread. Auction exchanges, or the auction market, is a place where buyers and sellers put in competitive bids and offers simultaneously. For example, in an auction exchange, the current stock price is the highest price a buyer is willing to spend on security, while the seller will accept the lowest price. Trades are then matched, and when paired together, the order is executed. The auction market is also referred to as an open outcry system. Brokers and traders communicate physically and verbally on the trading floor or pit to buy and sell securities. Although the system is slowly being phased out by electronic systems, some exchanges still use the auction system, including the New York Stock Exchange. The New York Stock Exchange is the world's largest equities exchange. The parent company of the New York Stock Exchange is the Intercontinental Exchange as a result of the merger with the European exchange Euronext in 2007. Although some of its functions have been transferred to electronic trading platforms, it remains one of the world's leading auction markets, meaning specialists called designated market makers are physically present on its trading floors. Each specialist specializes in a particular stock, buying and selling the store in the auction. These professionals are under competitive threat by electronic-only exchanges that claim to be more efficient. That is, they execute faster trades and exhibit smaller bid-ask spreads by eliminating human intermediaries. Companies listed on the NYSE have great credibility because they have to meet initial listing requirements and comply with annual maintenance requirements. To keep trading on the exchange, companies must keep their prices above $4 per share. The NYSE closing auction is the last event of the trading day when the closing price for each stock is determined by bringing all buyers and sellers together to establish a fee for all those involved. Electronic exchanges. Many exchanges now allow trading electronically. There are no traders and no physical trading activities. Instead, trading takes place on an electronic platform and does not require a centralized location where buyers and sellers can meet. These exchanges are considered more efficient and much faster than traditional exchanges and carry out billions of dollars worth of trade each day. The Nasdaq is one of the world's leading electronic exchanges. Stocks. A stock or share, also known as a company's equity, is a financial instrument that represents ownership in a company or corporation and represents a proportionate claim on its asset, what it owns in earnings, what it generates in profits. Stock ownership implies that the shareholder owns a slice of the company equal to the number of shares held by a proportion of the company's total outstanding shares. For instance, an individual or an entity that owns 100,000 shares of a company with 1 million exceptional shares would have a 10% limited ownership stake in it. Most companies have outstanding shares that run into millions or billions. While there are two main types of stock, common and preferred, the term equities is synonymous with common shares, as their combined market value and trading volumes are many orders of magnitude larger than that of preferred shares. The main distinction between the two is that the common shares usually carry voting rights that enable the common shareholder to have a say in the corporate meetings, like the annual general meeting or AGM, where matters such as election to the board of directors or appointment of auditors are voted upon. While preferred shares generally do not have voting rights, preferred shares are also named because they have a preference over the ordinary shares in a company to receive dividends and assets in the event of a liquidation. Common stocks can be further classified in terms of their voting rights, while the basic premise of the common shares is that they should have equal voting rights, one vote per share held. Some companies have dual or multiple classes of stock with different voting rights attached to each class. For example, Class A shares may have 10 votes per share in such a dual class structure, while the Class B subordinate voting shares may only have one option per share. Dual or multiple class share structures are designed to enable the founders of a company to control its fortunes, strategic direction, and ability to innovate. Advantages of stock exchange listings. Now, further in this video, we will talk about the benefits and problem of stock exchange listing. Until recently, the ultimate goal for an entrepreneur was to get his or her company listed on a reputed stock exchange such as the New York Stock Exchange. Because of the apparent benefits, which include an exchange listing means ready liquidity for shares held by the company shareholders. It enables the company to raise additional funds by issuing more shares. Having traded shares makes it easier to set up stock options plans necessary to attract talented employees. Listed companies have greater visibility in the marketplace. Analyst coverage and demand from institutional investors can drive up the share price. Listed shares can be used as currency by the company to make acquisitions in which part of all the consideration is paid in stock. These benefits mean that the most large companies are public rather than private. Huge private companies such as food and agriculture giants, Cargill, industrial conglomerate Koch Industries, and DIY furniture retail IKEA are among the world's most established private companies, and they are the exception rather than the norm. Drawbacks of stock exchange listing. There are some drawbacks to being listed on a stock exchange, such as significant costs associated with listing on an exchange, including listing fees and higher expenses related to compliance and reporting, burdensome regulations which may constrict a company's ability to do business. Most investors, short-term focus forces companies to try and beat their quarterly earnings estimates rather than take a long-term approach to their corporate strategy. Many big startups, also known as unicorns, because startups valued greater than $1 billion, used to be exceedingly rare, choose to get listed on an exchange at a much later stage than startups from a decade or two ago. While this delayed listing may partially be attributable to the drawbacks listed above, the main reason could be that well-managed startups with a compelling business proposition have access to unprecedented amounts of capital from sovereign wealth funds, private equity, and venture capitalists. Such rare access to seemingly unlimited amounts of money would make an IPO and exchange listing much less of a pressing issue for a startup. Numerous studies have shown that stocks generate investment returns superior to those from every other asset class over long periods. Stock returns arise from capital gains and dividends. A capital gain occurs when you sell a stock at a higher price than the price you purchased. A dividend is a share of profit that a company distributes to its shareholders. Dividends are an essential component of stock returns. Since 1956, dividends have contributed nearly one-third of total equity return, while capital gains have contributed two-thirds. While the allure of buying a stock similar to one of the fabled quintet Facebook, Apple, Amazon.com, Netflix, and Google parent Alphabet at a very early stage is one of the more compelling prospects of stock investing. In reality, such home runs are few and far between. Investors who want to swing for the fences with the stocks in their portfolio should have a higher tolerance for risk. Such investors will be keen to generate most of their returns from capital gains rather than dividends. On the other hand, investors who are conservative and need the income from their portfolios may opt for stock with a long history of paying substantial dividends. Hope you liked our video. Still hungry for knowledge? Please subscribe to our channel so that we can help you enhance your knowledge. Please share this video with your friends.